Okay, so good day everyone. So I will be your professor for this subject, AE213, Strategic Cost Management. For our first module, we will be discussing cost volume profit analysis. So to start with, we'll have the overview of the subject. So this subject is about cost volume profit. So this is also abbreviated as CVP. So here we will analyze the cost, the volume, and profit relationships. So this analysis is used as a powerful tool for planning and decision making. So here, the result of the analysis will emphasize the interrelationships of the variables that we have mentioned. So the costs, the quantity sold, and the price. It also brings valuable tool in identifying the extent and magnitude of economic trouble a company is facing and helping pinpoint the necessary solution. So here, the management is going to use CVP analysis to solve business-related problems uh, by using the results of the analysis for a sound financial decision making, especially in manufacturing firm. For the learning outcomes, so the students at the end of this module, you are expected to number one, determine the number of units and amount of sales revenue needed to break even and to earn a target profit. Second, you're going to determine also the number of units and sales revenue needed to earn an after-tax target profit. Third, you're going to apply the cost volume profit analysis in a multiple product setting. Fourth, you're going to explain the impact of risk, uncertainty, and changing variables on CVP analysis. And fifth is to discuss the impact of non-unit cost drivers on CVP analysis. Okay, so to start with, our first topic is about break-even point and target profit in units and sales revenue. Okay, so here for determining revenues, expenses, and profits, how they behave as volume changes, it is suggested that we will begin by computing or calculating the firm's break-even point. So when we say break-even point, this is the point of zero profit, meaning your revenues is just the same or equal to the amount of the expenses. So in this state, you will neither have profit nor loss. So break-even point can be determined in units and sales revenue. Meaning to say, you can compute the break-even points in the number of units, or that is, how many units should we sell to break even, and you can also compute for the break even in sales revenue, or that is, how much sales revenue does we have to earn so that we will have a break even point. So, two frequently used approaches to find the break even point are, so this is our approaches or methods. Number one is through operating income approach. And the second is the contribution or CM approach. So as we go along with our discussion, so we will deal with this in detail. So the determination of units or revenues needed to achieve a target profit is a generalized case of break-even formulas. So by the way, when we say target profit, this is the level or the amount of profit that the organization desires to achieve. Okay, so here, break-even point analysis will become helpful so that we will determine how many units should be sold to reach the target profit, or how much sales revenues does the company needs to earn so that they can reach their target revenues or profits. So that is why as we go along, you will be encountering formulas which were also derived from the break-even point formula. So the first step in implementing a units sold approach is to use the CVP analysis. Of course, this is to determine also the number of units. The second is to separate, of course, the cost into fixed and variable components. So, in your cost management or cost control and management course or subject, you have already learned about the different behaviors of costs. So basically, we have fixed, variable, and mixed costs. So here, in CVP analysis, it is very important that you know how to determine what costs or what type of costs are incurred by the enterprise, because this will be later used for the contribution margin approach, especially in determining the CM uh, margin. Okay, so here CVP will also focus on the factors that change the components of profit. So here in CVP analysis, we are going to study about the relationships or interrelationships of the different factors that affect the profit. Meaning, what will happen if, for example, the cost will decrease? So, what is its effect now on your profit? Will it uh, make your profit higher or lower? And also with the other factors. So, because we are looking at CVP analysis in terms of units sold, so we need to determine the fixed and variable components of the cost and revenue with respect to the number of units. So again, you are going to understand this better as we go through the different illustrations. Okay, so it is also important to realize that CVP analysis focuses on the firm as a whole. So therefore, all the costs of the company, not only manufacturing costs, but it could also include marketing and administrative costs will be taken into consideration. So here, uh, we will describe what is variable and fixed cost. So when we say variable costs, these are uh, costs that varies according to the number of units produced or sold. Okay, while fixed cost, on the other hand, does not have a direct relationship with the number of units produced nor the number of units sold. So, um, whatever the level of production is, fixed cost will remain the same. So here, your variable costs include cost that increases, as mentioned. So the typical or common examples of variable costs are our direct materials, direct labor, variable overhead, and variable selling and administrative costs. So here, all of these costs will increase if we will also increase the number of units produced. So they follow, or they have the direct relationship with the number of units produced. So here, fixed costs, on the other hand, are composed of all fixed overhead and fixed selling and administrative expenses. Or in other words, if you have already classified the other costs as variable cost, the remaining will be, of course, fixed cost. But of course, the examples will be depreciation, um, salaries, and wages of uh, the accountant, the president. Okay, so those expenses that do not actually have the direct relationship as to the number of units being produced. So regardless of the production, their balances will still remain the same. So this is the nature of fixed cost. So this is just a sort of review because you already have taken this into your previous uh, course. Okay, so what are the basic concepts in CVP analysis? So here, the fundamental concept and underlying CVP analysis is that, as we have mentioned in the previous slide, the costs can be broken or categorized into variable and fixed costs. So this is a useful tool, or CVP analysis is considered to be a useful tool for organizing the firm's costs into fixed and variable categories. So this will be uh, reflected later in our contribution-based income statement. Okay, so next, operating income. Here is the income before income taxes and includes only revenues and expenses from the firm's normal operations. And for our net income, this is used to mean operating income minus income taxes. So later on, I am going to describe to you the difference between the income statement that we normally prepare, okay, and the contribution margin based income statement. Okay, so we have here the illustration or example of uh, a problem that is related to CVP analysis. So I don't know if you can actually see the figure, so I'm going to adjust it for you. It's quite blurry.